Hi, everyone. This is the One Point podcast, and I'm Rohit Yadav. AI has taken the world by storm, captivating imagination of virtually everyone, from venture capitalists and startup founders to multinational corporations and big tech companies. Everyone is in the race to harness AI's transform power. The sheer speed of this growth is staggering. It's not just the surge in the private capital investments, it's also the incredible technological leaps happening at breakneck pace. Some say that the launch of ChatGPT in November 2022 marks the beginning of the third major technological revolution in 50 years, following the advent of personal computers in 1981 and the rise of the internet in 1994. And while AI dominates the headlines in the startup world, its transformative power on venture capital value chain is often overlooked. And as AI reshapes how the deals are sourced, evaluated, and done, this area deserves even more greater focus. So we have a perfect guest with us today, Guy Conway, to discuss today's one point of AI and data in the venture business. Guy, it's a pleasure to have you on the podcast.
Thanks for having me.
Before we dive into the topic, let me do a quick intro. So, Guy is the co founder of Koble, where they are re engineering startup investing with AI. Prior to Koble, a Guy launched Zero One Accelerator, where he focused on fundraising for the portfolio. His early career included roles in management consulting, mid market, private equity, and an MBA from London Business School. So, Guy, I'm really looking forward to our conversation today. Let's dive in. As a first question, please introduce Koble and your other initiatives to us all.
Sure. So, as you said, Koble we're re-engineering startup investing with AI. Some background to us, right? So we started this business about 4 years ago. We had a sort of frustration, general frustration with the way that the venture capital worked through working with the accelerator. Right? We always found the time to get startups funded as a bit hit and miss. Right? The feeling was you could take the same startup to the same investor on 2 different days, and one day it was good and one day it was bad. And as we unpicked the asset class and we looked into venture capital, what we saw was was quite surprising. Right? As an asset class, the returns on average are phenomenal. It's 20% IRR for the past 20 years. Right, it beats everything apart from crypto. But if you look into the numbers, right, what you see the median return, right, that the most common return for funds is 1x or less. And that sort of tied into was what we were seeing, that it was an asset class that relied way too much on gut feel, way too much on intuition, and as a result, you had this inconsistency of performance. And then when you sort of dive deeper, what you also find is that even the top performing funds right there, less than 1% of them are able to hit top decile 3 times in a row. So even the best funds sort of struggle with this inconsistency. So for us it showed us that the route to solve this was through an algorithmic VC or an AI VC. This was 4 years ago. 4 years ago when we started talking about this, we were laughed out of the room by some fairly prominent VC investors. 4 years down the line, I'm sure we'll kind of go into this. We've made some huge progress, and are quite excited about the next stages of our journey.
Awesome. So the way we can divide this conversation is let's focus on the AI and the data part in the venture business at first. And then we can go one step lower in what you are really involved in with Koble, what it really does, and we explore the depth of it. And in the end, we can switch to the personal side and ask some personal questions. Sounds good?
That's good. Right.
Okay, so let me set up the context for this venture business. So venture business is kind of a value chain, right? So we start with the one fund management where there's kind of setup done. You talk to LPs, you reach out to LPs, you get capital from them. There's kind of onboarding process to all of it. There are multiple closes. So all of that comes part of the fund management in the back office itself. Then there is the investment bucket to it. So there's a startup discovery process. There's startup then evaluation, due diligence, and then startup investment. And then once the investment kind of phase is done, then the VCs generally try to focus on the portfolio development. They try to add value to the startups. And obviously they want returns, right? So they want the startups to grow. So within this overall value chain, where does Koble sits?
So where we sit today is in startup discovery, selection, and investment decision.
And explain to us a bit more about what really do you focus and how do you really focus on the startup discovery phase and the evaluation phase? Do you think all the other VCs are also starting to use, let's say, AI and data to a larger extent within the investment phase itself?
What we've seen become more commonplace in the last couple of years is VCs like to talk about their use of AI, their use of machine learning in startup investing. But when you unpick what they say, when you sort of have deeper conversations, you see where they're really focused is on discovery, right? And you have to think why are they doing that? And I think there's a couple of key reasons at play. One is discovery is the low hanging fruit. That's the easiest thing to automate. Is it machine learning? I don't even know if you would call it AI, right? There are ways that you can find startups that are being formed. It's fairly commoditized, right? There are companies like Harmonic in the US, companies like Landscape, figuring out the ways that you can uncover maybe 95% of the startups that are being formed. And of course, you need to bring your own layer on top of that to find the ones that are hidden or to find them sooner. But the idea of discovery, I think, is fairly commonplace. I think why funds like to talk about using AI and then they sort of only go as far as discovery is because, as I said, right, it's low-hanging fruit. What you find if you want to push a boundary further through to investment selection and even IC, right, that's where it becomes more and more difficult, right? You're talking about orders of magnitude, more complexity. And then you have to also think about the incentive as a traditional VC, right? Let's call it that. As the pyramid of associates through principals and partners that justify the existence on the management fee. When you start to automate more and more steps in that process, you're really challenging the core existence of why these people do their jobs and why these funds exist and why they can charge that management fee. For me and for us as a company, we always found it quite surprising, right? That lots of VCs will tell you that the VC investment can't be automated, right? You can use AI as great at discovery, but when you get into selection and further down the line, it becomes impossible, and you need the human to do the job. Right? You have these VCs that are investing in some of the most advanced AI companies in the world that are transforming every industry on its head, but for some magical reason, investment selection can't be done by AI. So yeah, convinced it's possible, and I think it's a lot of firms will stay away from it because of those reasons.
So in general, do you think the traditional VC business model is in danger, or let's say it other way around, the traditional manager should be fearful of AI in the venture business? And how does it play with the junior talent? VC is still a relationship driven business. So relationship alpha does exist in private markets. It's kind of a proven thing. But with AI, the role of the junior members of the team, of the VC setup, is kind of being displaced. So how should they feel about the advent of the AI?
Yes, it's an interesting question. And I think you have to look at how innovation typically happens in an industry. It's very rare that innovation comes from within. There's a classic stories of Xerox and digital camera, you look at the electric cars and the true innovation comes from outside. The way that I think it happens in venture is that the introduction of these AI firms or AI-led VCs or Quant VCs, if you call them that, is they will come from the outside, right? They will become data scientists, mathematicians who figure out solutions to the problem. Listen, if you look at how these innovation challenges will be solved in venture, right, you will get the kind of the introduction of these AI VCs or Quant VCs. I think you will get hedge funds who are more set up to do this will also start to play more and more in the space. How AI disrupts venture, I think, let's be honest, right, the big brand funds, your Sequoias, your Accels, right, they're not going anywhere. The managers that they produce that want to go and do their own thing, right, again, they're not going anywhere. But I think what you will see is that there's a big chunk of kind of mediocre managers, kind of inconsistent returns, surviving, or kind of serious LP capital coming from kind of the government programs, that they're the ones that will start to struggle. And what you will see is you will get the kind of the high brand, kind of high value VCs will maintain a position, and you'll get this emergence of the Quant VC that will be quicker access to capital, quicker decision making, almost kind of detangling that value that exists in VC, which is take my money and take my advice. Quant VCs will be saying, hey, take my money and find the advice, but it's not necessarily going to come from us.
Okay.
And then the second part of your question, how it impacts junior talent, I think it's it's a wider question, right? If you speak to, I think, any analyst or associate now, more and more of their research, more and more of their work is being done. Some of the AI tools, right?
True.
More and more work is done on those tools. You start to question, well, why do you need the analyst? Why do you need the associate in the first place, right? We know that the founders of these startups, like, they want to have conversations at a senior level in a VC. They want to be talking to the partners, they want to be talking to the general partners.
Yeah.
If that work lower down the value chain can be automated, then why do you need that there in the first place? But I think it's difficult, right, to really kind of change the operating model of a venture capital fund. As a venture capital fund, does that come from within, or does that come from new funds that are emerging with different ideas on how the asset class can be?
Okay. Okay, maybe I can ask it in a different way. So, for example, if the role of discovery and due diligence is largely handled by the AI tools, how will the role for a junior member in a VC team transform? So, will they be focused more on the relationships then? How will that part act? Or, for example, let's take another case altogether. Do you see more and more firms which will come up which are solo VCs, or VCs which are having GPs just with the people with a lot of experience, and they themselves will then start using such AI tools, and they would not have a lot of bench strength within their team. So there could be like new shops of VCs, forming in.
Yeah.
So which portion are you kind of more inclined towards?
Good question. For me, I think it's how does the role of junior people evolve? I think it's more of a kind of holistic question than just within VC as AI tools emerge. If you, as you say, right, VC is a relationship, it's relationship alpha, it's a relationship asset class, it's a messy asset class at the moment. If your available spend as a VC fund that is being spent on juniors to do the discovery and selection isn't needed anymore, then really where your advantage is in is we're spending that money on it's more senior people, it's better quality of advisor. I think that's what will be the emergence of the funds that used to operate on the big platform team, the big operating team. That's where the money will be spent. I think the quant players, the ones that, if you look at their funds in the 70s and 80s, right there, how much money can be managed on as skinny a team as possible. Like some of the big funds billions of dollars with tiny teams, and every task they look at is can this task be automated? We find the cheap resource to do it. How do we make our engineers think the task can be automated? I think that will be the interesting one for VC, the ability to scale the asset class with manage huge amounts of money on tiny teams, because all those tasks that we thought to be done by humans don't need to be done.
Okay, so it's more of a reskilling kind of case for the junior folks within the industry, right? Tell us how the landscape is. How many quant VCs are there in the world? If you have that number, I mean, I couldn't find it in any report. Give us a sense of how the overall ecosystem of quant VC is right now.
Yes, so the way that we see it, and there's Andrew from Mentorship is doing lots of work in this space, but you have the traditional kind of the boutique VC, I think as you call it, it's almost the benchmark. You then get this emergence of data-driven, where you talk about bring data into the investment process. It gives you extra decision points. The cynic's view of that would be, if you're bringing data into an investment process, but there are still humans at the end of it, then what's stopping the humans discarding the data, and how much things really change. And then the emergence of VC, the purely algorithmic or proprietary play. It's a handful I've seen very many. It's very nascent. There's in the UK and in the US. And the ones that you see, are sort of talking about it typically at a later stage. I think would be a good example. They're very focused on the Series B stage.
So if you have to look at the value chain with respect to the round size, let's say seed, Series A, and so on, where do you think that most quant VCs will come at? So you mentioned one company focused on Series B. What's more kind of exciting or interesting stage at which quant VCs can come? The reason I ask this is because of data, right? The data at the seed stage or even pre-seed stage is quite a lot. So the usage of tools which use AI is far more beneficial at such early stages where you have probably thousands and thousands of startups. So the startup discovery process is much easier. The evaluation is much easier than before. So where do you see in this entire chain of stage wise the quant VCs will come primarily?
Yeah, it's quite interesting, right? So when you talk about building a VC or an algorithmic VC, what people will kind of naturally say is, oh, you must be doing this for late stage, kind of maybe Series A, but probably sort of Series B plus, because at that point startups have the financial data, the marketing data, the growth data that you need to build your models. What people sort of don't consider when they say that is the access to that data. Say if you need even 5,000, 10,000 startups and their historical data to train your model, you're just not going to get access to that data unless you're, Quant VC maybe, but people aren't that, and so they want to build these models for late stage, but they can't get the data they need. So it's very difficult to build those models.
True.
And then what you find is late stages, it's less a game of trying to pick winners because Series B, everyone knows who the good companies are.
Yes.
It becomes much more about get access at the right price. You necessarily need a model to do that, right? So the data is there to solve the problem, but you can't access the data, and then you probably access it because everyone knows what the good companies are. And if you look at the universal companies that are raising that, it's relatively small. Now, when you take it to sort of early stage, and by early stage I mean anything from pre-seed and seed. So for me, the definition of that is from day one of the startup to pre-seed probably less than a $5 million valuation, and seed less than 10 hopefully, but definitely less than 20. The problem becomes very different, and the alternative that you're up against also becomes very different, right? Because at pre-seed and seed, the investor hit rate is incredibly low. It's 2 or 3% of deals at pre-seed or seed go on to yield a 20x or more. So even though at pre-seed and seed that you're dealing with very inconsistent, incomplete, qualitative data, you can access that data. It tends to be around founders and markets and any previous investment. The data you need is there. The knowledge of the startup or the founders is there. The alternative, the next best thing, the current human rate is very low. So you don't have to be that much better than the status quo. And if you can be a bit better than the status quo, then you can beat the market. You see how money flows into strategies that can do that.
From what you said, so the initial stages, the early stages of the startup journey, I think is much more attractive from an AI in venture business point of view, right? How have you seen data evolve from the very early experiments 10 years back to what it's being used right now? You mentioned a couple of points of data availability with respect to market, with respect to founders. Yes, they are there from for example, LinkedIn and other sources like Crunchbase, PitchBook, and so on. Have you seen these tools using different data sets? Is there something called as proprietary data involved? How has data usage evolved in the last decade?
Yeah, I mean, what we've seen is we've been doing this for 4 years. I think you can talk about over a decade that the number of data sources that exist has increased, right? You've got things like your Deal Room, Founders, you've got LinkedIn, you've got People Data Lab. So the data sets for the private markets have started to evolve, and the early stage private markets have started to be included in that. The early attempts at, I wouldn't even call it Quant VC, I would say the early attempts at trying to predict the success of a startup from these data points, be that either industry or lots of academic studies, they tend to be from Stanford, MIT. Okay. They tend to focus on tabular data features, right? So they look at using the source data and say predictions from, definitely the classic example is your founder went to reputable university. But then you have the challenge of, how do you classify reputable university? These tabular features, what we saw, they're not enough to drive predictability. Again, it goes back to the comments we had at the start that says, the data sets that exist, if you work solely off them, it's enough to drive some initial filtering. It's also a huge risk that it makes you feel confident you can drive initial filtering, but if that's all you're doing, then you're at high risk of kind of excluding the outliers. But we found that you have to do a lot of work on these existing data sets to get anything that is remotely useful for driving predictions of early stage startups.
And so, another adjacent question. So, if the kind of data sets which are there in the market have increased but is same for all the AI tools which are using it, so the startup mechanism for filtering for startup discovery is, you know, is commoditized in a way. So if, for example, tens of VCs or 50 VCs are start using the same tools for the discovery phase, then where does the alpha really lie? That's the bigger question, right?
Yeah, for sure. Right. If everyone uses the same thing, then the alpha isn't there. I think the alpha lies in probably a couple of places. Is one, what do you supplement the off-the-shelf tools with? What ideas do you have that finds the gaps in those tools, or that finds what those tools are finding? But you find ways to find them earlier. And then the real alpha for me, it lies in it's not about taking a list this big and turning it to a list this big and handing it over to an
Yeah.
investment team. You have to be able to drive the investment decision from that initial list, because really that's the challenge, right? You have just providing a short list. Everyone's going to do the same thing. Everyone's going to look at the same criteria and come up with the same short list. It's how do you turn a list of, I don't know, a few hundred or 1,000 into 2 or 3 startups that you want to invest in. That's very difficult. That took us, the best part of 3.5 years to craft that to solving the problem, which is very difficult for international VC, right? Because they have to keep funding it, they have to hire the right people. It's not cheap engineering talent that is going to solve this problem. So it's maintaining that belief and commitment to the problem over multiple years to solve. And for me, that's why it hasn't been solved, right? Because if you look towards academia, these are very difficult problems to solve. They're very strength from the initial question, but they're very difficult problems to solve over a very long time period. Really, the crux of the problem is in the data, right? It's how you construct the data, it's how you clean the data. No high-flying PhD wants to spend 2 years of a 3-year PhD just, cleaning data. And if you look to industry to solve it, right, essentially VCs, right? Do VCs really want to fund these high-price engineering team to solve this problem in multiple years, when every dollar they spend on an engineer is a dollar less they can spend on investment professional, which again is that incentive, right? Are they really incentivized to fix this?
Okay. You mentioned really two nice points. So one is the data itself, data cleaning and so on, and the additional data that can be provided or can be used by the VCs, that becomes the alpha opportunity. The second is it's not just about the data, but what decisions that you take. And it has taken you a lot of years to work on that specific thing. I mean, I take inspiration from the public markets. I know it's not one-to-one example, but for example, Apple, right? The price of Apple is known to everybody as a stock, but one person might take, let's say, a long position, and the one might take a short position on it based on their own analysis. And kind of that becomes then the alpha opportunity for them, right? It's not about the data itself, which is known to everybody, but rather how you take decisions, how you kind of achieve whether you want to invest in that particular situation or not. That becomes kind of the alpha power for the investment phase.
Yeah, for sure. I think that's where it's going to get very, the next sort of 5-10 years in VC is going to become quite exciting, because you will, listen, if everything we've built ourselves is starting from publicly available data or data, there's much smarter people in the world than us. So you think if we can solve this problem, other people can solve this problem, you're going to get very different strategies or different results that emerge of the same data sets. So I think this concept that we have in VC at the moment, which is the idea of a hot deal or a hype deal, because 90% of VCs have the same checklist they're trying to find, and it becomes it's relating to alpha. When people start to interpret these data points in different ways, or find different sources of data sets, or combine these data sets in different ways, there's going to be some. I think some more unconventional businesses or unconventional founders will start to find easier access to capital.
Moving out of this investment bucket, you mentioned that within this entire VC value chain, you guys are focused on the investment part and so on. But there are two portions on the flanks. One is the fund management side, and the other one is the portfolio management side. Which portion do you think is much more interesting for AI to be implemented? do you see any startups coming on those areas using AI, using data to kind of, make things more efficient?
Yeah, I mean, listen, I think fund management is hard. I think if you talk about the fundraising process, it can change in time, but these are very long cycles. These are, if you think the venture investing side is a relationship business, then the LP side is relationships, to a multiple of 10. And sure, you have to believe that things can be different. It's a long. To me, the portfolio management stuff becomes quite interesting in terms of, how do you get the right talent to a startup, and that can be employees, contractors, advisors. I think for a long time, the asset class has relied on this value proposition of money and advice. And if you're taking investment from a VC, then you're taking advice from that VC, be it a board member, or an observer. Pre-seed and seed, especially when you start to look at the breadth of startups that start to get investment and the complexity of the technology, and that's only getting harder, and it's only growing faster. It's how much can a VC really support a portfolio that invests in deep tech and biotech? Does that advice really sit within the fund, or do you start to find ways of bringing the right advice to the startup and incentivizing them in a way that makes sense to them? I think that would be the next step. Businesses will start to.
Good. Let's switch gears. So let's focus on Koble now. So you mentioned about the use case that you're focused on, startup discovery, investments, and so on. What makes you the perfect team to solve for this?
So it's not. There's a Jim Simmons, founder of Renaissance Technologies, pioneer in quantum investing. He once famously said that data scientists make the best traders.
Yeah.
We agree, right? We're a team of mathematicians, a team of engineers, physicists. We're not VC investors by trade. We haven't grown up in the capital ecosystem. We came through being entrepreneurs and running an accelerator. So we have a different view. We have a different on the asset class. We approached it by very sort of data focused, very quant focused. I'm almost trying to unpick some of the truisms sort of being passed through in VC. That there's lots of things that are sort of taken as fact when let's bring data into the equation, let's analyze things in a different way, and see if we can different investment decisions.
So coming from outside of the industry, I think is what makes you better suited to solve for this challenge. Tell us about the journey of Koble right from the beginning. What were the ups and downs in between? Were there kind of moments where there was light bulb going in your head and saying, maybe we should do it differently? Tell us all about it.
So listen, as I said, we started 4 years ago, just over 4 years ago, with a view or hypothesis that we could take the human out of the venture capital investment process, right? So can we come up with an investment decision on a startup? Can we do it in a way where we don't need to meet founders and we don't need to see pitch decks, right? So what data can we take from the public domain or pay to access sources that help us drive to a portfolio of investments, and that portfolio can perform returns over a consistent result. And listen, when we started, we always had a view that what we were building should have, we should be deploying capital based on what our technology was discovering. I think 4 years ago in London, and I think still to an extent today, that the early stage, like the angel community, they like the SaaS model. They want to see things at a B2B SaaS. It's more understandable. It's more comparable. And so the initial vision for the business was that we were going to build these algorithms. We would then package them up and we would sell them on a subscription to the other investors, mainly VCs. And if you look on Crunchbase, right, you can convince yourself there's 10,000 VCs in the world. When you start to get into it, you realize actually there's a few hundred Series VCs, and of those VCs, there's a percent of them would consider purchasing a tool like that, and then those that will consider purchasing it, the willingness to pay for anything, piece of tech is we found was always benchmarked to a people license, sort of seen as the gold standard, and nothing can be more expensive than a people license. So,
got it.
As a result, the scalability of the selling a SaaS product to VCs is very difficult. What we also found is that if you're telling a customer base, we've built these algorithms that can beat the market, then the response is, best off the back of them, as opposed to trying to sell them, because that's where the real value is. So, we have multiple occasions. It's, if you're trying to sell an algorithm that can predict the success of venture, you're either lying that it works, or you're an idiot for trying to sell it. So, it's clear to us that deploying capital was the way forward. So what we're building now is the ability to invest. We want to make investments based on what our algorithms are uncovering. We want to be sort of deploying capital in a pragmatic way in the pre-seed and seed stage. Listen, as I said, when we started, we were left in the room. We were taught that venture is an artisan trade. You have to look a founder in the eye. You have to shake their hand. You have to kind of get a feel as to whether it's a good investment. And these are words I'm making up. We heard them from some high-profile VCs. But we've been on a journey, 4 years of work, a year of R&D, wow. 2 years of data construction. Lots of people like to focus on the fancy modeling, but we realized very early on that it's the data, right? That's where the IP is, that's where the edge is. And what we spent most of our time doing was taking these source data sets that everyone has access to, and we have 14 models that sit between our source data and our model, and that's where the complexity came, and that's where the real work and IP and secret sauce, if you want to call it, is. But we've done huge amounts of work, huge amounts of testing. Now we're seeing some really exciting results in what we've built, and we're now kind of running these discovery engines. Right? We're seeing some really exciting startups that we could be investing in, with the funds to deploy. So, hopefully that will come later this year.
Okay. Wow. Congratulations on this journey, and fingers crossed on the launch. So you are doing both now, right? So you're working on Koble at one end, you're still providing it to VCs as a SaaS service, or have you really closed it down?
No, so we decided to sort of pivot the side of the business. The focus right now is in getting the funds ready to deploy. And listen, for us, that's kind of proves the efficacy of what we're doing. We have to be able to deploy capital. We have to move out of a world of testing and validation into a world of this is a portfolio. Right? These are the startups. These are the founders. These are the investors. And for us, then, as a business, right, that's when opportunities start to open up. Do we sell to VCs? Maybe do we work with family offices? Do we work with non-competing industries? Right? We know people like to be able to price a risk. Want to be able to price a risk on a startup. People want to be able to understand where they focus their sales effort. If they're selling to thousands of startups, they want to be able to know which startup should they focus their emphasis on, because they're the ones that become the customers. We see huge use cases for technology, but people need to believe that it works, right? And that comes through some investments.
Okay. And if you treat this engine, right, AI engine as a product, what's your ultimate vision for this product? Let's say 2 years, 3 years, 5 years down the line.
We focused on the ability to make an investment, come up with an investment decision on a startup, without seeing the founder, without seeing the pitch deck. So automating from discovery through selection and an investment committee. For us, what comes next is we want to be able to deploy automatically into a startup. We think technically that's easier than behaviorally. We think founders still want to know who their VCs are. They want conversations. So I think that will change over time. But we see the ability to deploy money pragmatically to a startup. So, a startup, we find a startup, we say, we think you're a good investment. Get investment in the next day, which would transform the fundraising process for startups. So I think that comes in the next kind of couple of years, maybe slightly longer. If you're talking about VC, then you have to think about a couple of things that you can't get away from, which is one is you start to deploy pre-seed and seed the asset class only supports so much, right? So how do you then build models to take on the later stages, the Series B stages, so you can deploy more funds? And then final, the big challenge is liquidity. Right? You then start to solve some of the liquidity challenges that the asset class has. So you sort of move into the secondary space, or if you're building these portfolios of startups, multiple startups in the early stage, you start to securitize them and almost kind of bundle them and create ETF style products of startups. Investment portfolios. So there's lots to take on. Like I said, we're starting at the moment with pre-seed and seed investments, but there's exciting things around late stages, exciting things around secondaries, there's exciting things around products that are incredibly commonplace in the public markets, and there's no reason why they shouldn't be possible in the private markets too.
And within, let's say, this engine, have you defined, you mentioned that, there's so much that you can take at the pre-seed and seed stage. So are you focused on one single geography or one single bucket area within the business areas like climate tech, fintech, or something else? Or is it global approach that you're taking with your tool?
Yeah, so listen, our models were trained on data from UK, Europe, Israel, and the US. So at the moment, that's where we would sort of feel comfortable deploying. We would like to go globally. The challenge is just less familiar with some of the data sets across regions, and the quality of the historical data to train the models isn't as good as what you see in Europe and the US. From a sector perspective, we're sector agnostic. We look at the ingredients of the early stage startups, founding team, market spaces, and the way our models work is we have one model that determines whether we think it's a startup that has a chance of success, and then there's a second sort of portfolio construction model that makes sure there's kind of appropriate balance within the portfolio. From a sector agnostic pre-seed and kind of early seed is the focus.
Okay. So would you also envision building like a model, AI model to test which area is the hottest area, which market is kind of booming, and that would select AI itself?
Right. That's part of the way we look at markets. That's how we try to understand where is there a space that we think there's a venture scalable company, and where are some of the companies within ones do requisites for good.
Okay, so there is not just let's say founder specific or startup specific kind of KPIs, but there's also market specific KPIs. How big is the market? How the market is changing, evolving, scaling, and so on, which you integrate within the decision making process. Makes sense. Last question within this bucket: do you think there is a first mover advantage for companies building in the AI space for venture capital?
I think what the scarcity within the venture space is LP capital. Certainly at pre-seed and seed, there's more than enough startups to be investing in. So the scarcity is within the LP space. The first mover advantage is LPs really incentivized to take that risk on, and new models and new strategies to just as good a place to come in. I think historically, if you look at some of the funds like correlation ventures, Signal, education process of different strategies in venture has come. You might argue that they were the first movers. They sort of showed that there were different approaches possible. So I think it's less of a case of being first mover advantage and more a case of being able to demonstrate huge rigor in the way that your technology is built. Testing is what we call auditable, right? So the toughest quant see and approve the back testing. I think that's where the advantages lie, less so in being first and quick, and more so in showing the depth and rigor of an approach.
Okay. So do you think for a product like what you're building or a tool like you have, there's more LPs who exist in the US universe? Because there are hedge funds which do exist. They have integrated AI to a large extent, not in last 5 years, but even before that, right? So there are quant-based hedge funds which have been doing such strategies of working, have PhD level people, data scientists working for them, and they're much more open-minded in investing in such areas. So do you think that US is the geography to go for such ideas?
Yeah. I think there's clearly that the US ecosystem is bigger, it's deeper. There's more of an appetite for risk. We're having some very good conversations in the US. We're also having some very good conversations here in the UK and parts of Europe. What we found is that it's well known that venture has been through a fairly torrid time the past few years, since the boom of the kind of COVID years. And lots of LPs have got frustrations in terms of money locked up in funds that aren't being marked properly, underperforming GPs, or just inconsistently performing GPs. And what we see is there is a real willingness and appetite to try and find innovative strategies, different strategies within venture, because everyone knows the asset class performs, right? You look at the results of the past 20 years, the asset class has consistently demonstrated, IRR. It's the way you extract the value of that asset class, and LPs who are interested in the space, they want to see people that have ideas for doing that in a more consistent and reliable way.
Got it. So switching to a personal side, the journey is always tough, right? So spending 4 years on this, you must have many ups and downs moment, right? So what made you stay motivated yourself? How did you keep mental balance on tough days?
I mean, listen, I think it comes down to the team that I'm sort of fortunate enough to work with. There's a real belief, a real commitment to solving the problem. Kind of significant fortitude in wanting to solve that problem. We see the opportunity. We're kind of old enough that we know we can solve it. And there's always been a core set of investors and shareholders who believed it's possible and wanted to see it possible, that there are, so that this kind of idea automated Quant VC is possible, and we've always been able to raise the investment that we need to keep going further. Listen, the first 2 years were tough, right? It was trying to solve a problem that people wanted to believe was unsolvable, doing some really complex work in terms of getting the data sets ready, but then you start to see the fruits of the effort, and you start to see the results of the modeling work and things you try to start to improve. So it's not an easy journey by any means, but the kind of the size of the pie, right? This is the golden egg, right? If you can automate early stage venture, then it's what people would like to do. So that kind of passion for solving the problem, I think keeps you going.
Great to hear. And you touched upon it a little bit. What was the role of advisor and mentors or well-wishers in your journey overall?
I mean, hugely important, right? For us, the advisors and mentors weren't necessarily the people that invested directly, but they always came through those relationships, which again is why I'm a believer that the VC doesn't have to add the value, the investor doesn't have to add the value, but they should be unlocking the doors or helping you find those relevant people. We've had an amazing chairman in role for 2 years. Strategically, has really helped us navigate some of the more difficult times when it comes to technology or business model or kind of fundraising. We have a board of advisors again who understand the problem, and I think they all fundamentally share the same passion for solving the problem, so they're willing to give you their space and their mental capital to kind of get ideas to get through some of the days when you're sort of staring at a brick wall.
Awesome. Amazing. So in the end, I will ask you one question. I mean, you don't have to think about venture capital business, but what's the one interesting, inspirational idea which you recently read or heard that you would like to share with the audience?
So the quote that kind of came to mind. I'm not sure if you're a football fan, Rohit, but there was Marcelo Bielsa. Marcelo Bielsa is a famous football manager, has some strange ideas. He once said that a man with new ideas is a madman until his ideas triumph. Yeah. And that sort of has kept us going on many days where people said, things aren't possible.
Amazing. Thanks, Guy. Thanks for joining us and recording this amazing podcast. I think there's a lot of inspirational nuggets and insights embedded. Thank you so much. And fingers crossed and all the best to you for your journey.
Thanks, Rohit.
Take care.
Cheers.